The mutual fund sector in India, after a slump of 3 years, is finally witnessing some achhe din in the markets. India's oldest fund house, UTI, is also seeing one of its best growth years this fiscal. How have things changed, and would FY16 be the year where UTI will finally come out with its IPO? To discuss all that and much more in detail, we have with us Managing Director of UTI, Mr. Leo Puri. Mr. Puri, thanks for sparing this time and speaking to ET Now. To begin with, we could ask you, would in that sense FY15 be one of the best years that your fund house will witness in the recent past?
Certainly, I think if you go back to 2007-8, this will probably be the best year both for us as well as for the industry as a whole. So indeed, we're all very happy with the current
What will
situation.
the kind of growth that you are looking at in terms of growing your AUMs by and also in real terms?
I think at this point, we would look certainly at 20-25% as being the year-on-year growth. And it depends obviously on how the last quarter goes, and the budget expectations will play a role there. But I would safely say 20-25% should be comfortably achieved.
So, important aspect, how differently the sector this time has handled this whole situation, the bull run that we are witnessing, vis-a-vis say what was the experience in the past, because mutual fund sectors somewhere in the past have burned their fingers badly for various reasons. How are things different this time?
I think the previous pattern, as you know, is the problem that people essentially buy when the market is high and then sell at the first sign of panic. I think what we are seeing is, I hope, more sustained buying and a willingness to hold through the cycle. Purpose of participating in the equity markets for a retail investor is not to avoid losses altogether. It's to make sure that the gains outweigh the losses, which typically will occur when you actually hold your investments through the cycle. So we are seeing a little more willingness to hold despite recent volatility, and I think if that sustains, we should see a sustained return for retail investors.
Mr. Puri, when you say willingness to hold, does that also mean slowly but surely the retail investor once again back into the equity markets via the mutual fund route? How are the numbers stacked at this point of time?
We're seeing folios rise again in the industry as a whole, and certainly our own experience with the NFOs we did is that it brought a very large number, 60,000-70,000 in each case, of investors back into the market. So retail investors have definitively re-entered the market. There is going to be market volatility, however, given global conditions and given some of our domestic political uncertainties as well. I would only caution investors to stay put. We are probably 1/3 of the way through a bull run, if you like, in terms of Indian equities. We're still relatively early. It's not too late at this point to participate. The markets should deliver yields of, let's say, mid-teens over the next 2 or 3 years, which will be a very, very healthy return over inflation. So I think staying put, staying steady, not losing your head is the key.
A very important aspect, Mr. Puri, even recently SEBI chairman mentioned to this in terms of penetration. If we compare it to say what internet has done or a retail has done, and even the latest Pradhan Mantri Jan Dhan Yojana, in terms of new folios, do you think is this the time where mutual fund industry as a whole and maybe UTI, the oldest fund house, need to go out there and tell retail investors, guys, this is the time to enter the market, please come and invest, which is not happening that much to the expected lines?
Yeah, I think we are quite inspired by the comparison with the Jan Dhan Yojana for mutual funds. And as you know, UTI's own mandate was always to democratize access to capital markets. And I would remind you that we have 1 crore of the 4-odd crore folios are with UTI. We still have nearly 1/4 of total folios, which is a sign of our commitment to financial inclusion and small ticket sizes. I think what's very important to realize is that we will, in addition to digital, need physical distribution to grow. I think both need to grow in parallel. You do need to add to the number of IFAs and distributors that are willing to come into the market, and that has been our experience. We continue to grow and empanel distributors, which is why we are seeing growth in B15. and much beyond B15. In fact, 71% of the people who came into our NFO, in the second NFO, where we raised 900 crores, came from B15. 71% is a large number. So we need to be able to incentivize new distributors, small distributors, to keep coming into the markets if we are going to have any hope of increasing penetration, apart from investments in technology and mobile and digital platforms, where clearly the industry can do a lot more.
Very interesting aspect, Mr. Puri, as you rightly mentioned. Going beyond top 15 cities has always been a challenge, and perhaps you are the only player or one of the few players who have efficiently managed to do that. Where do you still think the challenges are, and what needs to be done to ensure that to take mutual fund beyond this top 15 cities, what needs to be done?
So first, as I said, is you must have distribution, both physical and digital, to provide ease of convenience to investors. Second is, I think we as an industry need to look at the products and the appropriateness of the products we are offering first-time investors. We need simpler products with more balanced risk and reward, and we need tremendous ease in terms of investor servicing. I would not underestimate that last point. Both entry and exit from the funds needs to be at least as easy as their experience with, let's say, fixed deposits. The day we achieve these three, I think we could succeed. I think investor education is naturally a foundational element of all of the above, and I think all of us are focused quite a lot on ensuring that too.
Mr. Puri, coming back to the other new product that was touted to get in a lot of investments is REITs. Market regulator SEBI has given the go ahead. Where do you think is the final hurdle? REITs is not taking final shape, or it's not taken off in that sense, where the expectations were huge, saying that a lot of investments could be attracted. What is, according to you, the hurdle that REITs is failed to take off?
There are two or three factors. One is that the tax treatment still needs to be clarified. The assets are held in an SPV, which today it seems will be taxed when it actually distributes dividends to the REIT itself. And that may create some tax inefficiency in the structure. Beyond that, I think you have to look at how this could be attractive, because if commercial yields are, let's say, in the region of around 8%, which means post a management fee or at 6.5%, 7%, that may not itself seem very attractive given where other risk-free investments are today. And I think sophisticated investors have also noticed that on the Singapore exchanges, where we've listed REITs, their performance has not been all that good so far. So perhaps there's a bit of apprehension around that. I don't think any of these are long-term issues because eventually we do have a very, very large and growing real estate sector. We will see capital appreciation, so I think that will address matters of yield. I'm hopeful the tax issues will get addressed. And I think once you have a track record of high-quality developers and high-quality asset managers coming together, confidence will get built in this sector. But I think it will take another year or two before we actually see that happen.
So just coming to the numbers when it comes to REITs, all sort of billion-dollar numbers have been coming forth, saying this is the kind of potential that REITs potentially could get in the money into the Indian system. As you say, the challenges and how things will pan out. So realistically, from 3 years from now on, what would the kind of money we could expect in, say, from an instrument like REIT in the mutual fund sector?
See, I don't think this is a top-down issue. I think you need to start creating a track record with a few high-quality developers putting high-quality assets into this vehicle to set a benchmark. If that doesn't happen, we could be waiting a very long time. But I think it's very important that we get the show on the road. And frankly, even if you get the show on the road with $1 billion or so, if you like, in the market, that would be a very good start. The long-term potential remains very high. The attractions for both investors and developers is very strong. So the market will develop, but we need somebody to get the show started. And I think in FY16, we will see that happen.
So when you say that, would, as always, once again, UTI be the first? Can we see a REITs coming out of your table very soon?
We are certainly looking to actively participate, and I think the issues I mentioned at the outset, I hope will all get addressed during the course of the next few months, and we would actively seek to partner with developers as an asset manager in this space.
So coming to UTI, it's almost been close to 1.5 years after you took charge and sailing the shape. How have things been for you personally, say if from a short term, mid term or a long term goals, how are you looking at UTI and particularly in this sort of a bull market, any specific target that you have set for yourself in terms of your growth, in terms of your new folios, as you are rightly saying 1 crore of the 4 crores belongs to UTI, and in terms of say taking your AUM surpass the 1 lakh figure mark, how are you looking at it?
I think we at the outset set ourselves 3 metrics. One is absolute growth, the other is clearly profitability, and the third is reputation. Reputation is a function of the performance of your fund and the performance of your brand. All 3 remain important. We are not just here to chase size for the sake of it and sacrifice profitability, nor can we afford to take our eye off performance, which is the only long-term guarantor of our success and the only reason why investors should trust us. I think over the last year and a half, we have made progress on all 3. I think performance of our funds has been ranked among the most consistent, if not the most consistent, in the latest CRISIL rankings that I saw. And I'm particularly happy that consistency is what differentiates us in that regard. Our growth has been healthy. I think we have, after a period of 2 or 3 years of uncertainty that preceded 2013-14, I think we have bounced back and shown the resilience the institution has. And we continue to be one of the more profitable and healthy AMCs. So overall, I think we are poised to actually start to re-establish the leadership and preeminence that we had. And the institution is responding very well to the market opportunity. There's also a process of cultural change and transformation underway. And I think the organization is responding well to that process too.
If I could ask you, sir, when you say transformation, particularly organization like UTI, say in the next 2 to 3 years, in terms of the funds that you come out with, the terms of the mix that you would want to have, what is that you are looking at?
I think first, in terms of customer focus, retail remains our primary focus. I think this business will grow when the retail segment grows. Of course, we want the institutional segment to grow and we want pension funds and insurance to come into the market, assuming regulations permit them to. But most critical for us is that the retail, underpenetrated retail and household participation grows. So that is a segment that we will focus on. Within that, I would say simple but high quality range of equity products and fixed income products is naturally what we are focusing on at this point in time. And making sure that the distribution and customer servicing can actually service the retail investors' needs. So that is our priority. I think 2 things could help us there. One is continued supportive regulatory environment. I must say the regulatory environment in the last 2 or 3 years has been much more neutral than the one that preceded it. And I think the industry has clearly benefited from that in terms of our ability to sign up distributors in particular. The second is the way in which we will use technology. I think we have seen efforts now by the government yet again to push a broadband revolution. And other industries are showing us the way that if we are able to leverage technology, I mean, e-commerce has exploded even in small towns and cities. We are a mobile-driven country and smartphone costs, as you know, are coming down rapidly. So certainly in the next 2 years, if we can design products to fix the new technology, to fit the new technology paradigm, I think we could see a very rapid growth in our penetration.
Would the target for you be coming into the top 3 in terms of your AUMs?
I think so. I think we would like to aspire to that. I think I often say that we are the only large independent asset manager that is not owned by a financial institution or a corporate. And we think that gives us a distinctive position. Around the world, when you look at leaders in this industry, they tend to be independent asset managers, not really corporate owned or bank owned. And we think that gives us strength in terms of our positioning, our independence, our governance. So we think it would be healthy for the financial system as well if a player like us continue to prosper, grow, and provide leadership to the industry.
Mr. Puri, if I could ask you, when you mentioned transformation, a very important aspect, particularly for an organization like UTI, it is witnessing some expert from a financial sector for the first time taking the organization forward. Would FY16 in that sense, as I put it in my opening remark, be the year where we finally seeing UTI unlock its value for its shareholders, because this has been going on back and forth in various form between you, the finance ministry, and the other stakeholders. So how are you looking at it?
I can comment from UTI's perspective. I think the reason why we are very positive about the idea of a listing is quite straightforward. One, we think it will help us achieve our goals. Listing will give us capital, it will bring retail investors in, it will strengthen our brand, it will strengthen our governance, it will strengthen our commitment to being a market-driven professional meritocracy, which is what we actually want to be. Second, a listing is in fact an ideal way to provide for all shareholders a price discovery mechanism, an opportunity for value creation, and indeed a path to exit should they wish to monetize and apply their value to their own core businesses. The third is it's a very strong commitment to financial sector and capital market reform, because here you have an institution which is still an important institution, which comes into the market as the first asset manager to be listed, will draw in domestic and retail investors given the strength of its brand, and will represent on the government's part as well a strong commitment to financial reform and in a way strengthening capital markets by bringing an entity into being that has got diversified shareholding, is board governed, and can independently operate with confidence in the marketplace. So we see very clear benefits, and therefore we are hopeful that this is something that will be supported. I would say though the Ministry of Finance is, of course, has to take a view on this, so I would not like to preempt that.
Mr. Puri, if I could ask you the other aspect before moving on to some macro, if you want to set the record straight, there's also been some talks going on to see if UTI Mutual Fund and perhaps SBI could be merged. All sort of buzz is going on in the market. Would you want to once for and all set the record straight? Has there any feelers coming in from the ministry? Has anyone spoken to you? Or what are your individual views on this?
Actually, our view as UTI is the only thing I can comment on, and our view is publicly stated that we think UTI should be a listed entity. Three essential reasons for this. One, we actually think a listing will support our growth plans as an independent, diversified asset manager, which is board governed, is a professional meritocracy, and is driven by the marketplace. Second, we think a listing will offer price discovery for all our existing shareholders in a fair way, allow them to monetize the value that they have created, which they can use for their core operations, and indeed take a path to exit should they so desire. Thirdly, it's a very strong commitment to capital market and financial sector reforms on the part of the government, that here's an institution which is 50 years old, it served its purpose in terms of democratizing access to markets. It stumbled 10 or 15 years ago, was supported by the government, has come back from that as a strong, well-performing, stable entity, and can re-enter the markets, draw in domestic and foreign investors, which itself is a catalyst for our domestic capital markets, and continue to thrive in the way that, let's say, an HDFC or an ICICI or an IDFC have. So you will have another pillar, if you like, in the financial system, and a testament to economic reform by the government at the same time. So we see a lot of positives in that, and that's really our view. We can't really comment on other perceptions that may arise. We can merely clearly state our own.
So clearly stating that no one has spoken to you about this particular theory that is being doing the rounds in the media and the markets particularly.
I can only restate that we are in a position to put our own views forward, which is what we have done, and we are fairly positive, given the strength and logic of these views, that will find support. once you're a listed entity, many people can come forward and put proposals. So perhaps what you are talking about may or may not follow thereafter. But it's our view that the first step must be to initiate a listing.
Mr. Puri, going on to the macro aspect, I remember speaking to you just 6 months back just before the elections and the results came out. How do you look at the macroeconomic picture at this point of time? The worst is over, growth momentum slowly but gradually is picking up?
Yeah, worst is undoubtedly over, and I think the aspiration and intent to get back to 7% GDP growth is very clear. We're going to see, I hope, a very strong commitment to further fiscal consolidation this budget. That's probably for me the most important indicator. I know there's some talk saying we could in fact afford to relax our fiscal discipline at this point. I think that would be unwise. We are just building a reputation for fiscal probity. It's important we retain that. And I think the animal spirits are reviving in the economy. We are once again seeing signs of interest that there will be an investment formation, capital formation beginning again. That hasn't picked up fully yet, but I'd be very surprised if by the middle of this year you didn't see both domestic and global investors starting to come back and actually drive the investment cycle again. Once the investment cycle gets going, I think we'll be in a much more comfortable territory. That's, I think, the indication that one is clearly looking for, and I am confident we'll see that happen by the middle of the year.
And from the market's perspective, is this a sustained bull run that we are witnessing, particularly with all global biggies betting big on India?
Yeah, I think India is actually not immune to global forces, but it is not entirely dependent on them either. As you know, we are an economy that is, for better or worse, less dependent on global markets than perhaps others that have followed a high growth path in Asia. So our domestic management, or the domestic management of our economy and our political system, is the real key. To the extent we sequence reforms well and keep the political balance right and continue with the intentions that we have to free up and unshackle labor, land, and resources in this country, it is very clear that we can actually sustain the 7%, which is a very, very high relative growth rate compared to where the world is at this point. And I think, therefore, I would say we are still relatively early in terms of a positive cycle for India and therefore for the markets at this point in time. And I don't think we should see that cease for at least the next 3 or 4 years.
And Mr. Puri, my last question, a question which will be asked to every CEO in the next 3 weeks. Your expectations from the budget, say from the economic perspective and also from the industry that you represent?
The one point I would highlight is the importance of continued fiscal discipline. I don't think we should take the temporary support of lower oil prices as being an excuse to relax that. I think it is very important, particularly given our own poor track record over the last several years of fiscal probity, that we signal strongly to our own as well as global investors that India has finally turned the corner when it comes to the discipline of fiscal management. That is the single most important message. I know people would like to hear reform messages, and I'm sure we will get those as well. I think those will be perhaps more atmospheric. My expectations on that are not perhaps as high as some people, but a very strong, clear commitment to fiscal probity and keeping us on the path of declining inflation and interest rates, I think will be the real catalyst for growth going forward. For our own industry, to be honest, I think we have our list of demands. We'd like to see exemption of capital gains on merger of schemes. We'd like to see, again, balanced, fair, level playing field with ULIPs when it comes to switching between schemes. We'd like to see an enhancement of limits for ELSS beyond Section 80C. But I don't want to be too parochial about these. I would just leave it at that. I think those issues tend to get discussed.
So Puri, once again, thanks a lot for sparing this time. It's a pleasure talking to you as always.
Thank you. Thank you very much.
Find Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.